The U.S. stock market has experienced several crashes throughout history, often leading to financial turmoil, economic downturns, and major changes in financial regulations. While these crashes have caused short-term losses, they have also provided valuable lessons for investors, regulators, and policymakers. Understanding past stock market crashes can help investors make informed decisions and avoid common pitfalls. Here are the top 10 U.S. stock market crashes and the lessons they teach us. 1. The Panic of 1907, the need for a central bank. In 1907, a series of bank failures and speculative investments caused a sharp decline in stock prices. The crisis worsened when trust companies, which operated like banks, faced mass withdrawals, leading to a liquidity crisis. Wealthy banker J.P. Morgan personally intervened to restore stability, but the panic highlighted the need for a central bank. This eventually led to the creation of the Federal Reserve in 1913. Lesson: a strong central banking system is crucial for financial stability and crisis management. 2. The Wall Street crash of 1929, the dangers of excessive speculation. The 1929 stock market crash, also known as Black Tuesday, marked the beginning of the Great Depression. Excessive speculation, easy credit, and overvalued stocks fueled a massive bubble, which eventually burst. Stock prices plummeted, wiping out fortunes and leading to widespread economic hardship. Lesson: avoid excessive speculation and be cautious when stock prices rise too quickly without fundamental support. 3. The 1987 Black Monday crash, the impact of automated trading. On October 19, 1987, the stock market dropped by over 22% in a single day, the largest one-day percentage loss in history. The crash was triggered by computerized trading programs that automatically sold stocks when prices started to fall, creating a downward spiral. Lesson: technology can amplify market volatility, and risk management tools are essential to prevent excessive losses. 4. The dot-com bubble burst, 2000 to 2002, the importance of valuation. During the late 1990s, investors poured money into technology stocks, many of which had little or no profits. The bubble burst in 2000, leading to a prolonged decline in stock prices, particularly in the technology sector. Many companies went bankrupt, and the Nasdaq lost nearly 80% of its value. Lesson: invest in companies with strong fundamentals rather than following market hype. 5. The 2008 financial crisis, the risks of overleveraging. The 2008 stock market crash was triggered by a housing market collapse and excessive risk-taking by financial institutions. Banks issued risky subprime mortgages, which were bundled into complex financial products. When the housing bubble burst, major financial institutions faced insolvency, leading to a stock market meltdown. The Dow Jones lost more than 50% of its value before recovering in later years. Lesson: high debt levels and complex financial instruments can create systemic risks. Diversification and risk assessment are essential for long-term investing. 6. The flash crash of 2010, the role of high-frequency trading. On May 6, 2010, the stock market plunged nearly 1,000 points in minutes before recovering just as quickly. The flash crash was caused by high-frequency trading, HFT, algorithms executing rapid-fire trades. A single large order triggered a series of automated sell-offs, leading to the sudden drop. Lesson: automated trading can create unexpected volatility, emphasizing the need for proper market safeguards. 7. The European debt crisis, 2011, the impact of global events. In 2011, fears of a European financial collapse caused the U.S. stock market to decline sharply. Debt problems in Greece, Italy, and Spain raised concerns about global economic stability, leading to a drop in investor confidence. Although the crisis was centered in Europe, U.S. markets reacted strongly. Lesson: global events can significantly impact U.S. markets, making it essential for investors to diversify internationally and stay informed about global economic trends. 8. The COVID-19 crash, 2020, the power of economic stimulus. In March 2020, stock markets experienced one of the fastest crashes in history due to uncertainty surrounding the COVID-19 pandemic. The S&P 500 lost over 30% of its value in just a few weeks. However, aggressive stimulus measures, including government spending and Federal Reserve actions, led to a rapid recovery. Lesson: government intervention and economic policies play a significant role in market stability and recovery. 9. The 2022 bear market, the impact of inflation and interest rates. In 2022, rising inflation and aggressive interest rate hikes by the Federal Reserve caused a prolonged market downturn. Investors feared that higher borrowing costs would slow economic growth, leading to a decline in stock prices, particularly in the technology sector. Lesson: inflation and interest rate changes have a major impact on market performance. Understanding monetary policy can help investors make better decisions. 10. The banking crisis of 2023, the importance of bank stability. In 2023, the collapse of several U.S. regional banks, including Silicon Valley Bank, SVB, and Signature Bank, shook investor confidence. Concerns over banking liquidity and exposure to risky assets caused a stock market dip, although swift action by regulators prevented a deeper crisis. Lesson: bank stability is crucial for market confidence. Monitoring financial institutions and diversification can help protect investments during periods of uncertainty. Stock market crashes are an inevitable part of investing, but each one offers valuable lessons. From avoiding speculation to understanding the impact of global events and economic policies, history provides insights that can help investors navigate future market downturns. While crashes can be unsettling, a well-informed and disciplined investment strategy can help mitigate risks and capitalize on long-term growth opportunities.